Now, inflation, according to official statistics compiled by Stats SA, fell to 4.9% in August from 5.5% in July. But it is debatable whether this figure accurately captures the increase in living costs for the average South African. With inflation under control, Reserve Bank Governor Jill Marcus has the luxury of potentially lowering interest rates at the next meeting of the MPC. Here to discuss the interest rate cycle is JP du Plessis from Prescient Investment Management. Let's just start perhaps by chatting, JP, about the environment. I mean, when I look at your fund and I think about perhaps the kind of the targets that you have, I am thinking, shouldn't the target just simply be beat inflation and more?
Well, look, that's really over the longer run, that is our target. We have a benchmark of 110% of STEFI, which is a cash rate. But over the longer run, inflation is really the enemy of any investor, and that's what we strive to achieve.
Hi, JP. Just to ask you, we just want to, there seems to be this disconnect between the inflation rate that's published by Stats SA and what we see as ordinary South Africans in the market at the moment. Costs for almost everything I can think of that we purchase on a month-to-month basis have been going up way further than the 4.9% indicated by Stats SA. What's your take on the actual basket and the methodology that Stats SA is using to measure inflation? Because at this point, to the ordinary South African, inflation is far in excess of 5%.
It's always a very interesting debate. Very difficult to pinpoint one basket for the whole of South Africa. Obviously, you have a very broad range of different income groups and different parts that products that people use, and it certainly feels to the man on the street that inflation is running at much higher rates than the numbers suggest. But I think Stats SA is an independent body and does as good a job as anybody could. It's what you feel. And I think this is a debate which has been raging for years and years. And I remember my grandmother going on about inflation and how it wasn't what was being published. So, it's a perennial debate about the inflation number. But it's as good as a number as you can get. What you have to remember is, of course, that that is an annual rate which just reflects the change in price from one year to the next. So if you have a big increase and then it sort of stagnates, then that can affect the way that the number is calculated.
Now, JP, I understand that early next year that Stats SA are going to be reconfiguring that basket. Can you just tell us a little bit about the changes that they're going to be making and how that might impact on the basket from where it exists at the moment?
Sure. Look, that's one for the conspiracy theorists, because my understanding is that the changes will bring inflation down marginally. But my understanding is that it hasn't been fully sort of brought in or fully accepted yet, and the impact of it isn't 100% clear. But it does look like that could bring the inflation basket down, or the inflation rate down just a touch. But more or less, the rates are going to stay, in the kind of band in the region that they're in at the moment.
Just to talk about a conspiracy theory of my own, JP, I've got this theory. Obviously, if you believe that inflation, the official inflation rate, doesn't reflect the experience of rising costs for many South Africans, with growth looking increasingly muted at this point as well, are we in for a period of stagflation going forward? And for the benefit of our viewers, stagflation is a combination of no economic growth or very low economic growth and high inflation. I'd like to get your views on that.
Look, it's certainly clear from the way the policymakers, central banks, both in South Africa and around the world, are acting, that they would rather err on the side of having a bit of inflation than having growth fall off a cliff. And so the rates that are being set around the world, the huge amount of quantitative easing that we're seeing, etc., is really to try and generate some growth, generate employment, run the risk, if you like, that we have higher inflation rates. There's still reasonable output gaps out there, so it's hard to see inflation really taking off. Obviously, in South Africa, we have the rigidities in the labour market. We also have the effects of the rand. So, it's quite possible that if we saw rand weakness, we saw a round of wage negotiations that was higher and administered prices that were higher, that we could see inflation even with a pretty anemic growth backdrop. So, that is a risk.
Yeah. JP, can I just bring the conversation to the issue of the ultra-low interest rates that we're seeing around the world? Surely your job these days must be much easier, beating, say, for instance, as you say here in your fund, right out the cash as well as the short-term bond market return, given the low interest rate environment these days.
Well, you're absolutely right. I guess our job is never easy, but never an easy one. But it's not only the low cash rates, but the fact that is driving investors into riskier assets and bringing down the spreads available on riskier assets. So we've seen spread compression as well. So the amount that you get paid over government bonds has been coming in as people are searching for yield. It's had a dramatic impact on our bond market. We've seen a huge amount of foreign flows into our markets in that search for yield. You're not getting that yield in US and Europe, and they're coming into our markets and buying our bonds. So it has an effect on not only the kind of rate that central banks publish, but also the other kind of instruments that are involved. So duration has kept the duration, the yields on longer dated bonds low. Credit spreads have come in. It's definitely a difficult market to try and produce inflation beating returns. Just
to touch on that, JP, I just wanted to ask your opinion around the sensitivity of inflation to the exchange rate for one, because at this point I have a thesis in that with the labour unrest in the mines, which generates a significant portion of our export earnings, the rand might be vulnerable to a blowout if we don't see some of that export earning being generated in the short term. We've also had the South African bonds included in the World Government Bond Index, and I think you'd be familiar with the massive amount of flows that have been coming into that bond sector, as you've alluded to. If the rand does blow in the next 6 months, and we see a marked increase in the price of dollars and euros from a rand perspective, how long must that be in place for it to sort of move the needle in terms of inflation?
Well, yes, it's you're absolutely right on the sort of backdrop that you've been giving. What we are seeing is significant risks to the rand. We're seeing current account deficits, which continue to increase, and this mining unrest is not going to help the situation. We're also seeing that being propped up with the bond flows. And that could very well feed through into the inflation picture. The Income Provider Fund, which we're talking about today, has a little over 14% exposure to US dollar assets. And the reason why we have that exposure in an income fund to offshore currencies is exactly that. So that if we do see weakness in the rand, and that we're seeing a lot of risks of that happening, that the fund will benefit as a result, and also manage to keep up with inflation that's imported inflation.
Yeah. So let's talk about then your investment strategy. I see from your note here you speak about the fact that you're focusing on a high yield credit-linked notes from good quality issuers. Surely that must be easy for you to find in this environment where we know a lot of corporates are sitting with huge amounts of cash, and generally balance sheets are looking a lot healthier than they have looked for a long time.
Yes, that's absolutely true. That the better quality credits have been getting better, if you like. Earnings have been coming through, and their balance sheets are shored up. The issue, of course, is the converse of that is, of course, that the risk involved in those is reduced, and the additional spread that you're achieving by going into those names has reduced. So we are still finding credits to add to the portfolio. And we have a large number of credit in the portfolio, which has enabled us to add to the yield and achieve achieve inflation plus returns. But nevertheless, it's becoming more and more difficult job with those spreads compressing.
JP, just to ask you, your mandate in this particular fund is fairly broad, but there are some limits. Just to paint a picture around securitization and what many brand name companies are doing when they've got credit customers is repackaging their loans into securitizations and selling those to investors. Does that instrument fall within the parameters of your portfolio?
Well, we could invest in securitizations. We typically haven't done much in the past. We don't like the opaque nature of the investments. Very often the pools are very, it's very difficult to understand what type of credit risk you're actually taking on those pools. In the past, running up to the crisis of 2008, a lot of people relied on ratings to kind of rubber stamp the quality of those securitizations, and as we all found out, that didn't work. What we will do is we do look at securitizations and where we're being compensated for the risks intrinsic to the securitization, and where we can really understand the underlying assets, we'll certainly look at it. But we don't feel like we're getting compensated for those risks as it stands at the moment, so we don't have securitizations in the portfolio.
Yeah, I was just taking a look at the performance of your fund here from the sheet that you gave us. Over the 1 year, you're looking at a return of 8.9%, and then over 3 years, that's 7.7%. 5 years, you're looking at 9.4%. So very much pretty steady. Are you looking perhaps in the in the medium to longer term to perhaps increase those returns, particularly given the environment that we've been talking about now? But of course, the challenge that would also come along with the projected weaker rand by many people's projections.
Well, look, the way that we manage money at Prescient is very, very much risk focused. We put risk first, and so we tend to run very low volatility funds in general. This fund can have allocations to asset classes like property, like offshore currencies, offshore assets, which can in themselves be volatile. But what we'll do is we'll focus on value and make sure that we're comfortable with the kind of risks that we're putting into this portfolio. This is an a portfolio focused on income investors, and so it needs to be structured with that in mind, that you don't want significant drawdowns in the fund. So we will go about making sure that firstly that whatever goes into the portfolio is value. Bear in mind what kind of volatility we can expect from that asset class. Of course, value does reduce volatility to some extent, because if something is value, it's less likely to drop precipitously. And then we'll look at that and combine the different asset classes where they show value. And the beauty of this fund is that because it has the ability to look at a number of different asset classes, you can actually go about generating the additional yields and the additional returns that you talked about in the fund.
Sure.